Hello, my name is Devin Watts, and this is my presentation on Peachtree Securities Incorporated for Case B. In this presentation, we will be looking at TECO Energy Security, and we'll look at the value of the preferred stock, the common stock, and the expected growth rates for TECO Energy Security. To begin the preferred stock, we look at Series A stock. And you see the par value and the percent of dividends paid out and the current stock price. And with those numbers, we were able to find the nominal expected rate of return of 9%, along with the effective annual rate of return of 9.31%. The next preferred stock is the Series F stock. This is a little bit different situation where we have a total of 300,000 total shares outstanding and selling off 60,000 over the next 5 years to the total depletion of these shares. And so calculating this out, we took the present value of each year after the sell-off or sinking of the 60,000. So finding the present value, the sum of all present value for those shares, we found it to be $31,322,068. And then we divided that sum of the present values by the total beginning shares outstanding and found the value of the Series F preferred stock for TECO to be $104.41. Looking at the value line evaluation and the expected rate of return over multiple years, we found in 1992, with dividends of $1.80, we expected the rate of return to be 14.09%. The expected dividend yield and expected capital gains yield for beginning of 1992 were respectively 8.09% and 6%. Then we looked at the relationship between the dividend yield and capital gains yield. And under the constant growth assumption, we found the dividend yield and capital gains will continue at a constant rate. And what conditions have to hold true for this constant growth model or the Gordon growth model? We found the real world stocks usually tend to happen, or the conditions hold true with companies that have large caps or a historical stable growth rate. The dividend and stock price is expected to grow at a constant rate, and the expected capital gains yield must also remain constant. Now looking at the common stock, we look at the values over a few years. And looking at January of 1992, we found the value to be $28.56. And looking at the end of 1992, the value came to be $30.62. And then looking at the end of 1993 or beginning of 1994, the value of TECO common stock to be $35.26. Looking at the expected dividend yield, capital gains yield, and total return for 1992, we found the dividend yield to be 6.3%, the capital gains yield 7.2%, and total return is the sum of those two yields to equal 13.5%. Then we looked at if the required rate of return is 13.5%, what would TECO's stock value be, or would TECO's stock value be higher or lower than our Part A answer? And we found that the value for TECO's stock, if the dividend was $1.80 over the next 5 years with a constant growth rate of 6% after that 5 years, we found the value to be $19.76, which is approximately $8.80 lower than the stock price we valued earlier in Part A. For the stock's expected rate of return at the beginning of 1992, if we use a stock price of $22.26, we found the expected return to be 14.09%. If we use the information provided in the value line tables, we found that the assumed 6% growth rate is not reasonable, as we calculated the figures in the value line table, we found the growth rate to be 5.15%, which is not in the trend of the 6 and 7.5%. For the last question of the common stock, we look at is this growth rate sustainable? And we found the growth rate to be calculated out to be 5.09%. And we found that through the retention rate, given the figures for those years over 1995 and 1997 for the return on equity, earnings per share, and dividends per share. We use those numbers to calculate out the retention ratio along with the growth rate. And this calculated growth rate does not support the 7.5 rate given in the problem, which assumes the growth is too small for a sustainable growth rate. To conclude this presentation, the expected rate of return is higher for TECO's common stock. The constant growth assumptions will affect our valuation, and the growth rate for projected earnings are not sustainable. Thank you for listening. That is it.